Welcome to G Fun Facts Online. Today we are diving deep into the invisible engine of the world economy. Imagine a vast, invisible machine that hums beneath the surface of your daily life. Its gears turn silently, yet their movement dictates whether you can afford a mortgage, how much your groceries cost, whether your local coffee shop stays in business, and even the value of the cash in your wallet. This machine is not run by elected politicians, but by a cadre of technocrats in fortress-like buildings in Washington, Frankfurt, Tokyo, and London. This machine is monetary policy, and its mechanisms are the levers that move the world. While often viewed as dry economic theory, monetary policy is, in reality, a high-stakes drama of power, psychology, and mathematics. It is the story of how humanity learned to tame the chaotic beast of the business cycle, or at least learned to put a leash on it. In this episode, we are going to dismantle the machinery to see how it works, examine the historical battles where these weapons were forged, and look ahead to a future where money itself is being reinvented. To understand the mechanism, we must first understand the machine's purpose. At its core, monetary policy is the process by which a nation's central bank manages the supply of money and the cost of borrowing to achieve specific economic goals. However, not all central banks are created equal. Their operating systems differ based on their legislative mandates. First, look at the Federal Reserve, or the Fed. The most powerful central bank in the world operates on what is known as a dual mandate. Congress has tasked it with two co-equal goals, which are maximum employment and stable prices. This creates a constant tension. To boost employment, the Fed might want to lower interest rates to spur growth, but doing so risks overheating the economy and causing inflation. Balancing these two is like trying to drive a car while simultaneously pressing the gas and the brake. Contrast this with the European Central Bank, or ECB. Born from the trauma of 20th century hyperinflation in Germany, the ECB has a single primary mandate, which is price stability. Economic growth and employment are secondary considerations, pursued only if they do not threaten the inflation target. This structural difference explains why the ECB is often slower to cut rates during a crisis than the Fed. Then, there is the Bank of Japan. As the pioneer of modern unconventional policy, the Bank of Japan has spent decades fighting a different beast entirely called deflation. Its mandate has effectively evolved into a desperate struggle to generate any inflation at all, turning Japan into a global laboratory for monetary experiments. Now let us look at the toolbox. For most of the 20th century, central banks relied on a standard set of tools. These are the conventional mechanisms. The master lever is interest rates. When you hear that the Fed raised rates, they are not changing the rate on your credit card directly. They are changing the federal funds rate in the US, or the policy rate. This is the interest rate at which commercial banks lend to each other overnight. Banks are required by law to hold a certain amount of cash in reserve at the end of every day. If Bank A has excess cash and Bank B is short, Bank A lends to Bank B. The central bank sets the target interest rate for this transaction. This creates a ripple effect. If it becomes more expensive for Bank B to borrow overnight, it charges its customers more for business loans and mortgages to cover that cost. This ripple spreads through the entire economy, cooling down spending. To enforce this rate, they use open market operations. This is the hydraulic system. The central bank does not just declare a rate, it forces the market to adopt it by buying or selling government bonds. When buying bonds, the central bank pays for them by magically creating digital money and crediting the bank's reserve accounts. The result is that banks have more cash, so the price of cash, which is the interest rate, falls. Conversely, when selling bonds, the central bank takes cash out of the system, making cash scarce and driving the cost of borrowing up. There is also the discount window, which is the lender of last resort function. If a bank cannot borrow from other banks because of a financial panic, it can borrow directly from the central bank at the discount rate. This is usually set higher than the market rate to discourage banks from using it unless absolutely necessary. Finally, there are reserve requirements, which is the brute force tool, where the central bank simply orders commercial banks to keep a higher percentage of their deposits in the vault. This is rarely used today, because it is like using a sledgehammer to crack a nut. Now, how does a rate hike in Washington actually cause a construction company in Arizona to lay off workers? This process is called the monetary transmission mechanism, and it travels through four distinct channels. First is the interest rate channel. This is the most intuitive path. When the Fed raises rates, the prime rate goes up. Adjustable rate mortgages become more expensive. If a factory upgrade was projected to return a 5% profit, but the loan now costs 6%, the project is canceled. Spending drops and the economy cools. Second is the asset price channel, or the wealth effect. Monetary policy moves markets. When the Fed cuts rates, bonds become less attractive due to lower yields, so investors flood into the stock market and real estate seeking returns. Stock prices and home values rise. Households then feel richer because their retirement accounts and home equity are up. This psychological wealth effect causes them to spend more, even if their actual income has not changed. Third is the exchange rate channel. Money flows where it is treated best. If the ECB raises rates while the Fed holds steady, global investors move their capital into euros to earn that higher interest. Demand for the euro rises, causing it to appreciate against the dollar. This makes European exports more expensive, hurting manufacturers, but makes imports cheaper, lowering inflation. Fourth is the credit channel. This focuses on the availability of loans. When policy is tight, banks become nervous. They do not just raise rates, they stop lending entirely to riskier borrowers. This credit rationing hits small businesses the hardest. While these conventional tools worked for decades, in 2008, the conventional machine broke. The global financial crisis was so severe that central banks cut interest rates to 0%, and the economy still plummeted. They had hit the zero lower bound. If the gas pedal is already floored, how do you go faster? You invent a new engine. This ushered in the era of unconventional warfare. The first major invention was quantitative easing, or QE. If you cannot lower the price of short-term money any further, you try to lower the price of long-term money. The central bank buys trillions of dollars of long-term government bonds and mortgage-backed securities. By creating massive demand for these bonds, their yield is forced down. This lowers the interest rates on 30-year mortgages and corporate bonds, forcing investors out of safe bonds and into riskier assets like stocks. The scale was massive. The Fed's balance sheet exploded from roughly $900 billion in 2008 to nearly $9 trillion by 2022. Another tool is forward guidance, which uses psychology as a weapon. Instead of just setting today's rate, the central bank promises to keep rates at zero until unemployment drops below a certain target. Businesses act on expectations. If a CEO knows rates will stay low for years, they are more confident investing in a new factory today. Then there is the upside-down world of negative interest rates. Used by the ECB and the Bank of Japan, this mechanism effectively charges commercial banks a fee to park their excess cash at the central bank. It is a penalty on hoarding cash, effectively telling banks to lend the money to the real economy or watch it slowly disappear. To see these tools in action, we can look at historical case studies where policy shaped history. First, look at the Volcker shock from 1979 to 1982. The US was paralyzed by stagflation. Psychology was broken, as everyone expected prices to rise, so they did. Paul Volcker, the new Fed chair, took a radical step. He stopped targeting interest rates and started targeting the quantity of money. He restricted the money supply so tightly that the federal funds rate shot up to 20%. The cost was a brutal recession with unemployment soaring to 10%, but it worked. Inflation was crushed, dropping from nearly 15% to 3%. It proved that a central bank must sometimes cause short-term pain for long-term gain. On the other side of the spectrum is Japan's lost decades. Japan experienced a massive asset bubble in the 80s. When it popped, the economy entered a deflationary spiral. Consumers stopped spending because they expected goods to be cheaper tomorrow. The Bank of Japan cut rates to zero, but it was not enough. In 2012, Prime Minister Shinzo Abe introduced Abenomics, featuring aggressive monetary policy. Governor Haruhiko Kuroda committed to doubling the monetary base, buying not just bonds, but stocks and real estate funds. The verdict was mixed. Japan ended deflation, but it never hit its 2% inflation target sustainably, showing the limits of monetary policy when a population is shrinking. We can also compare the crises of 2008 and 2020. In 2008, the Fed moved fast, but the ECB, haunted by inflation fears, actually raised rates in 2011, a disastrous mistake that plunged Europe into a double-dip recession. By 2020, central banks had learned their lesson. When COVID-19 hit, the response was synchronized and overwhelming. The Fed cut rates to zero in emergency meetings and unveiled facilities to buy corporate debt and even Main Street loans. The speed was unprecedented, preventing a financial freeze, but the massive liquidity injection sowed the seeds for the inflation we saw in subsequent years. However, monetary policy is not a free lunch. The unconventional era has birthed significant side effects. First is the inequality engine. Quantitative easing works by boosting asset prices like stocks and houses. Since the wealthy own most of the assets, critics argue that a decade of cheap money has exacerbated the wealth gap. Second is the zombie firm problem. When money is free, weak companies that should have gone bankrupt stay alive. These zombies hoard labor and capital but do not innovate, dragging down long-term productivity. Third, there are global spillovers. In 2013, when the Fed merely hinted it might stop buying bonds, panic swept global markets in what became known as the taper tantrum. Capital fled emerging markets to return to the US, showing how developing nations are often held hostage by decisions made in Washington. Looking to the future, the machine is being upgraded. The next decade will see changes that dwarf the introduction of QE. The biggest revolution is central bank digital currencies, or CBDCs. Central banks are terrified of losing control to cryptocurrencies. Their answer is digital cash. With a CBDC, citizens could have accounts directly with the central bank. Imagine a recession hits. Instead of lowering interest rates and hoping banks lend, the Fed could airdrop digital money directly into your phone wallet. To fight inflation, they could put an expiration date on your digital cash, forcing you to spend it. This bypasses the banking system entirely. Then there is green monetary policy. The ECB has begun tilting its bond purchases away from carbon-intensive industries, arguing that climate change poses a financial risk. The Fed has been more resistant, arguing that environmental policy is for elected officials. Finally, we have AI and algorithmic policy. Currently, policy lags because it takes months to realize the economy is slowing. Future policy might use real-time data from satellite imagery and web scraping to adjust interest rates automatically via smart contracts, removing human hesitation. In conclusion, monetary policy is the invisible thread weaving through the fabric of the global economy. From the crude lever of interest rates to the futuristic promise of programmable money, its mechanisms define the boundaries of our economic lives. As we stand on the precipice of a new era facing climate change, digital disruption, and extreme debt, the machine is under more strain than ever. Understanding how it works is no longer just for economists. It is essential for anyone who wants to understand the world we live in. The invisible hand is moving, and it is reshaping our future. Thanks for listening to Fun Facts Online.